All right, welcome to The Explainer. Today, we are diving deep into a really intense debate that's happening around a super popular incentive from home builders, the mortgage buydown.
So just imagine this for a second. You're out there, you're looking for a house, and you see an ad for a brand new home with a mortgage rate of 3.99%. Wow, that sounds absolutely incredible, right? Especially when the average rate these days is floating way up over 6%.
But is it just too good to be true? That's the exact question that buyers and housing experts are really wrestling with right now. For some, it's an affordability lifeline. For others, it's a super risky deal with some serious hidden costs. So let's get into it and unpack both sides of the argument. To really get a grip on this whole thing, we've got to understand why homebuilders even started using this powerful tool. It didn't just appear out of nowhere. This was a very strategic move to deal with a huge shift in the market. So let's just rewind back to 2022. Mortgage rates. They just went wild. They skyrocketed from a pretty comfortable 3% all the way up to a peak of over 7% in just a matter of months. That huge jump basically slammed the brakes on the housing market, and it left builders sitting on a ton of new homes they suddenly couldn't sell. So what do? Instead of just slashing prices everywhere, they got creative. They started offering these things called mortgage buydowns. Here's how it works in a nutshell. The builder pays a big pile of cash to the lender. In return, that lender gives you, the home buyer, a much lower interest rate. And boom, your monthly payment is suddenly way more affordable. And here's where the math gets really interesting from the builder's point of view. See, to get a buyer to that same affordable monthly payment, they've got two main options. They could just cut the price of the house by, say, 10%. Or they can do this rate buy down, which only costs them about 3.2% of the price. You can see why for the builder, it's kind of a financial no-brainer. And look, this quote from D.R. Horton's CEO just lays it all out there. Builders know what we all know. For most people buying a house, the number one thing they care about isn't the total price. It's the monthly payment. Can I afford this every month? And this tactic hits that number directly. And the result? Well, it's created this massive competitive advantage. The big national builders, they have the deep pockets to offer these deals all day long. That's why almost 2/3 of them do it. But the smaller, local guys, they just can't afford it. Only 13% of them can compete on these terms. All right, so let's dig into the first side of this argument, the case for the buy down. We'll see how builders and their supporters frame this whole thing as a clear win-win for home buyers. The core argument you'll hear from folks like Ken Gear is that a lower rate isn't just about saving a few bucks each month. No, they argue it's actually a powerful tool to help you build wealth and ownership in your home much faster. So how does that work? Well, it's actually pretty simple. Think of it this way. With a lower interest rate, less of your monthly payment is getting gobbled up by interest charges to the bank. That means more of your hard-earned cash is going directly toward paying down your principal, the actual loan on your house. You're building real ownership from your very first payment. So when you look at it from this perspective, the buy down seems like a perfect solution, right? It helps a buyer get into a home they can afford, it helps them build wealth faster, and by avoiding big price drops, it actually helps keep property values stable for the entire neighborhood. Everybody wins. And they've got some numbers to back this up. It turns out, when you look at the FHA data, homeowners who get these builder-backed loans are actually less likely to fall behind on their payments than the national average. The argument is simple. Lower payments make for more financially stable homeowners. Okay, but there's a whole other side to this story. And critics, they paint a very different picture. They argue this intense focus on the monthly payment is basically a magic trick, and that these deals come with a huge hidden cost that's baked right into the price of the home. The central criticism, and you hear this loud and clear from people like Ed Pinto at the American Enterprise Institute, is that by using buydowns instead of cutting prices, builders are artificially propping up home values. They're keeping the sticker price higher than what the market would naturally dictate. And we're not talking about a tiny bump here. Research from AEI suggests this price inflation could be as high as 10 to 12%. Think about that. You could be paying a massive premium for that house, and you might not even realize it because you're so focused on that sweet, low monthly payment. And that creates a really serious risk for you, the buyer. If you buy at one of these inflated prices and then life happens and you have to sell in just a few years, your home could be worth less than what you paid for it. That's what people call being underwater on your mortgage, and it is not a good place to be. And look, don't think this is some rare thing happening on the fringes. No way. A report from Morgan Stanley found that these buydowns are everywhere, especially with government-backed loans that a lot of first-time buyers use. A staggering 75%, three-quarters, of new homes with Ginnie Mae loans have them. This isn't the exception anymore. For many, it's the rule. So, you've got these two completely opposite takes, right? One side's calling it an affordability lifeline. The other is calling it a hidden price trap. With all that on the table, what are you, the potential home buyer, supposed to do? How do you even think about this? Okay, this table, I think, breaks down the trade-off perfectly. Let's walk through it. If your number one goal, your absolute priority, is the lowest monthly payment you can get, then yeah, a buydown is an amazing tool. But the con is that you might be achieving that by overpaying for the house itself. That puts you at high risk if you need to sell soon. And sure, you build principal faster, but you're starting from a higher, potentially inflated price, which can slow down your real equity gains.
And at the end of the day, for a lot of people, it really comes down to what this economist from Realtor.com said. They're laser focused on one thing. Can I afford the payment right now? For them, that monthly budget number is all that matters, and the total purchase price is almost just noise in the background. Which leaves you, the homebuyer, with the million-dollar question: is that short-term relief you get from a low payment worth the potential long-term risk of an inflated home price? Honestly, the answer is different for everyone. It really depends on your personal finances, how much risk you can handle, and probably most important of all, how long you're planning to stay put. It's a huge trade-off with no easy answer.